You've been looking at real estate in Decentraland,
Oh no.
the
Your real
metaverse.
estate broker said, Brett,
Meter is now down to $5 per square meter.
wait, but time out. We're talking about metaverse land, right?
Yeah,
What a steal.
seriously. You get 2 properties for that price.
Hey man, rates go up, opportunities are popping everywhere. What are you gonna offer? 30 a square foot?
I will
Oh, no,
offer
you
nothing
said meter. You said meter, by the way, right?
per square. Well, they determine it per square meter.
Yeah, that makes sense to me.
I'm looking for a tear down in the metaverse. I'm gonna fix it up myself.
That's great, dude. You and Victoria are gonna be so happy.
Doesn't even make sense what I just said.
You can't even keep it going that long. Jeez. Oh, this is
Rather
good.
have the best house in the worst house in the best area than the best house in the worst area, right?
I've heard that before.
Except it doesn't work in the metaverse, where you can just simply snap your fingers and end up in a different part of the town.
Yeah.
Welcome to episode number 32 of Talk Your Chart. I am Brett Horowitz with the amazing Marcos Segura. So Marcos, we just came off of the first quarter being over. Today is April 5th. The first quarter was a wild quarter. So I want to start with the headlines and please tell me what you think about all these headlines. We had extremely high job growth, which meant that the economy may be picking up speed, not slowing down. Inflation is not slowing whatsoever. We've got 2 giant banks that collapsed in the middle of March. One of them was the second biggest ever. We had Credit Suisse that had to get bailed out. We've got fighting in Ukraine. We've got fighting with China. We've got a housing slowdown. We've got falling bond yields because everyone thinks we're going to be in a recession. Interest rates keep going up, and more people are using their credit cards to buy things that are even more expensive than they were a quarter ago. How does that not lead to an awful first quarter in the markets?
Because markets are forward looking.
Just that, huh?
That's all.
Well, I think, as we talk to clients, they're always telling us about all the things that are going wrong. And I think if you and I put together a top 10 of things that are going right, we can find a list of all the things that are positive about it, the world and the economy, right? As we said, everyone's got a job. Most people who have a job, who want a job, can find one. They're being paid well. The values of their accounts have started to go up in the last 6 months. Interest rates are still quite low, even though they've risen from where they were a few years ago. They're making money now on their cash. So there's a lot to be said. And it just comes back to me with this singular one chart here showing how good the market was in 2023 in the first quarter across the board, stocks, bonds, everything, that there's a big disconnect between everything we hear on the news and see in the headlines versus what the market does. And some of it could just be, it wasn't as bad as what we expected it to be.
I think I'll give you a permanent truth that I do my best to live by. Disaster happens too fast to ignore. Progress happens too slow for anyone to pay attention. And what I just said, markets are forward looking. So I'll give this back to you though. What if, and I guess you have more than, you have the US and you have outside the US here. Outside US valuations look better even on a relative basis, meaning international is always cheaper than the US because quality. But even when taking that into account, international still looks good from a price standpoint. US looks expensive. So what if markets still haven't priced in enough of an earnings recession?
Yeah, it's possible. I mean, the argument, everything I said about why are the markets up could be just, we haven't had the bad news yet. It's still coming in the future. Earnings are still going to get weaker, and we've now hit the peak. On the other hand, though, I would say only a few weeks ago, CDs and bonds were producing a guaranteed 5% over, you can get it over a 2 or 3 or 4 year period of time. That's come down quite a bit. And if everyone's correct and the Fed keeps lowering rates, and now you're talking about interest rates in the 3s or 4s, or low fours or upper threes, suddenly that threat of competition to stocks is far lower than it was when you got bonds paying a guaranteed 5.
Yeah. So you said money market funds. So Jamie Dimon put out his annual letter, and he gave a stat here I hadn't heard before. So banks are competing with money now that rates have kind of normalized, not only among other banks, but also with money market funds, other investments, and the Federal Reserve itself. Money market fund total assets have increased by 650 billion since April 2022.
Yeah,
and we're part of that problem.
I mean, almost every client dollar that we can find that's not used or needed in the near term is in a money market, because you're getting 4.5% just to park it there.
Yeah.
I'll
So,
bet you in
yeah.
a year, though, it's not going to be 4.5%.
No, and that's the other problem. If you talk about why would I invest in the stock market if I can get 4.5%, 5% in a money market? I said, oh, that is true. 100% right now, you can get that.
Yeah.
But let me ask you, 5 years from now, what do you think will have a higher return? Equities or a money market? Well, that's a different question, of course, and there's no guarantee, but it's always a probability game. Right. And I'm going to go ahead and lean with a market still 16, 17% off highs. Let's go with the stock market. There's
been plenty of times where the markets have not delivered 5. There's been plenty of times where bonds have not delivered 5, because 5 is the bond, long-term historical average. Stocks around 10. But if bonds are going to be 5 and the stock market is, 1 billion times riskier, why would you not put your money in stocks and think it's going to be worth less?
Yeah, I hear you. So yeah, the markets have been great. Here's another stat that we were talking about earlier. Never, from counting 1950 to now, have you had a bear market where within the bear market, you've had 2 consecutive up quarters. And we just finished the second consecutive up quarter. So in my book, I think the bottoms were in October 12th of last year at down 25%. Doesn't mean we can't test those again. I don't think we fall past those again. I'll add to your kind of green shoots list of good market performance. This is also from the Diamond letter. All the good things that we're currently looking at: healthy consumer, healthy jobs, higher wages, good credit, home values have been up over the last 10 years, recovering supply chain, normalized interest rates, and healthy businesses. So, and again, why does he list all that stuff? Because it's not the great financial crisis, according to Jamie.
I mean, you're looking at these 2 quarters, at least on the U.S. market, being up almost 15% combined. That does not suggest that we're in tough times. So again, it could happen. And, you talk to clients who go out to restaurants or going traveling, everyone's raising their prices and everyone is continuing to pay it. So it could go down. Things could go, fall quite rapidly from where they are now. We could have more banking collapses in the future. But I think just look at the headlines and think, my gosh, it's horrible out there. It's really not.
No, and it's not going to be productive. And ultimately, look, I think neither you or I are telling anyone to invest dollars or put dollars at risk that can't afford to take risk. I think the same idea holds true. You need to have short-term reserves, and now just be grateful that you're going to get paid on those short-term reserves, whereas before you really weren't.
Yeah, I mean, there are certainly areas of the market that have not held up well in the last quarter. Right. So banking stocks that you're going to talk about in particular have gotten pummeled, not just Signature and Silicon Valley, but the banking sector as a whole. So it's not like everything's going well, but technology is just booming right now.
Yes. So good segue. Let's pivot to banks for a minute. So we talked about the whole banking crisis last time. It's probably still too soon to say that's behind us. But all signs point to stabilization, because you're not seeing the flows out of institutions like you were before. So we'll see what comes out of that. What I wanted to bring up was, it kind of played off a question that we obviously got a lot of, which was, okay, so Signature Bank and Silicon Valley Bank Financial Group, they don't exist anymore. How much of those companies were in my portfolio? If you're a client, I have a better idea. If you're not a client, I have no idea. But ultimately, if you owned an S&P 500 index fund, you owned both of those companies. So what happens now? That's a reasonable question. So I was reading an article by one of my favorites, Sam Rowe, and also an article put out by S&P Dow Jones Indices about exactly that, and basically the constitution and reconstitution of the S&P 500 index. So like, I guess for starters, right, the S&P Dow Jones Indices, that's the company that maintains the S&P 500 index. What's the goal of this company as it relates to the S&P? Maintain an index that best reflects the performance of the largest companies in the US. That's what they do. And then all these other funds copy the S&P. You think that's a reasonable explanation for what that is?
Well, yeah, if I could just quote one of our favorite financial journalists, Nick Murray. He wrote in an article recently, he said, not only is it a well-diversified portfolio, but they've demonstrated their ability over time, not only to survive, but to triumph over any and every crisis. And those that can't earn a superior return will stop what they're doing and or change what it's doing and or liquidate. And that pretty much is happening all the time with these indices. And there's nothing that you or I have to do about it. It happens, the index changes. Capitalism is doing that as a favor for us. So as you and I and all of our clients own the best and strongest companies out there that are constantly being replaced from the ones that are the weakest.
Yeah, so you just summarized everything I'm going to say. So let's hit on a few points and let's look at the chart. So first things first, here's a press release by S&P Dow Jones showing you that bye-bye Signature Bank, in comes Bungie, the company, bye-bye Silicon Valley Bank, hello Insulet. Never heard of them, but they're a healthcare company apparently.
Well, they're got to be massive, right? Because we're talking about the 500 biggest companies in the US. So we haven't heard of them, but I'm pretty sure they're a giant company.
Exactly, 100%. So March 15th, both these companies get the boot and you welcome in two new companies that are presumably at relatively the top of their game. This is a reconstitution, not because of a rebalancing, which S&P Dow Jones does on the third Friday in March, June, September, and December. This was a reconstitution because of two companies that went out of business, right? So they have those planned rebalances that everybody knows about, and everyone knows what's leaving and what's coming in. And then they have these that are caused by other events, which actually is what usually leads to someone being included or removed. Because not only do companies go out of business, but companies get acquired.
Right.
So you could also look at it as when a company in the S&P acquires another one, well, that just made room for a new one, but you still have the old one, right? Because now it's on the balance sheet of another company. So I think you hit on it perfectly. This is representative of a market that sees emerging companies grow and displace the old world stuff. So when S&P 500 was made and launched in 1957, this index looks nothing like what it was in 1957. And I think that's the beauty of allowing capitalism to do its job and S&P to do its job and saying, we're going to build you a way to access the 500 most profitable, successful companies in the US. And then obviously outside of the US through different indexes and providers.
I mean, we just take it back to the initial topic of all the things that are going wrong. And someone's saying, well, I don't want to be in the market because I don't want to be owning stocks when all these things are going wrong. The stocks that they're owning are the ones that are able to take advantage of this the best. Because the ones that can't, the ones that are failing are the ones that just disintegrate and get replaced. So you're taking advantage of the companies that will be able to get through those situations strongest and have the best earnings. And that's why over time, the S&P has consistently beaten almost every active mutual fund out there in existence.
Yeah, I know. It's impossible to beat it. And it's definitely impossible to beat it with any consistency or persistence. So let's put some numbers on the changes and the magnitude of that. That's what these next two charts are. So in this one here, we're looking at S&P's company composition between 95 and 2002 and the number of adds and drops. So from January 95 to April 2022, we had 728 companies that were added and 724 that were removed. That works out to about 26 changes per year, which means on average 0.8% of the S&P market cap is impacted each quarter. And obviously 0.8% sounds like nothing, meaningless, but again, compound 0.8% over time, that's a big difference,
For
right?
sure.
And to look at it another way, every 10-year period, you're basically replacing half of your index.
What I'm surprised about is that it's not speeding up, right? You always hear that the speed of change is getting faster and faster.
Yeah.
I would have expected if I was going looking at this, that over the last 20 years, I'd see more changes in the first 20 years, just because of technology and how fast companies are coming and then going.
So you and I both know that the amount of publicly traded companies has come down. Privately held businesses stay private for longer to avoid perhaps the ton of regulation and reporting requirements and compensation restrictions that come with becoming a publicly traded company. So maybe that has something to do with it, because the reality is companies like Instacart and Stripe probably go public way earlier, which they haven't yet, as opposed to what we're getting at right now. So we'll see where that shakes out. But ultimately, I still think the S&P company and then the index itself does a wonderful job of letting progress and innovation lead the way.
Yeah, I mean, no one wants those old fuddy-duddies anymore. You want the change to happen. It's worked. It's been successful for a long period of time. Let it continue. This recession that we keep talking about is obviously not here yet, and so we keep pushing it back quarter after quarter after quarter. So let's hope for another 7% quarter next quarter, make it 3 in a row.
Yeah, I mean, I don't want to lose my bet that the recession is this year, but I'd be okay with it.
But we kind of do want to lose that bet.
Nah, it's just delaying. It's not avoiding.
We'll see. No
Oh,
landing.
by the way, I still win if they call the recession in Q1 or Q2 of next year, because it has to just start in 2023. Let's get
We'll
that
talk
clear.
about that offline.
What?
We'll talk about that offline.
Oh, no, I want it recorded. I want it in the permanent record, buddy. Yep. Viewer, you heard it here.
Okay, we'll see. We'll see if we ever get to that point. But be well, Marcos.